Good morning and welcome to MarketCast 31 from a dark, dreary, wet, cold, rainy Bournemouth, extraordinarily, but the bright offices of AF Oliver. And although we have got a packed 30 minutes to get through this morning, heaven only knows how we're going to do it. I can't let this opportunity go by without mentioning my shirt. And hopefully you'd have already have picked that up. But for those who aren't quite so sharp-eyed amongst you, you might notice the Crystal Palace eagle in there. And a quick trivia question just to kick off this 30 minutes. Which Premiership football team won the FA Cup in 2025? The shirt should give you a clue. I was there. It was an absolute delight. We won't dwell any further on that. We'll let you enjoy the shirt as we run through the 30 minutes. We've got lots of very important things to cover and we need to get cracking. I hope you like my wolf in sheep's clothing. It took us hours to get the wolf to stand there long enough without taking the hand of the photographer off so we could get the sheepskin over the top of him. But here's the point. I'm going to give you data, I'm going to give you statistics that show that asking prices are up from April into May. They're going to show you that selling prices, completion prices are up according to Nationwide, because normally we do our market cast, don't we, at the back end of the calendar month, and we miss the Nationwide numbers. Well, of course, the Nationwide numbers came out the day before yesterday, so we've got the latest figures for you, and they are also up, but don't be fooled. This market has got a bite, and if you talk to people out on the front line, as I am doing on a regular basis, it just isn't that easy. And I want to touch in a bit more detail this morning on range. Let's talk about range and how that actually affects us. As a quick summary then to get us started, don't be misled by the fluffy numbers that I'm about to deliver you. This market bites. And asking prices, Rightmove say that they went up in May, although I've got to say the asking prices generally always go up in May, and this May they didn't go up quite as far as they normally do. Nationwide, they've got prices ticking up in April as well. I've got those numbers for you this morning. But despite all of these indices, it's tricky out there. Completions, we knew that, didn't we? I hope you're a regular MarketCast listener, and if you are, you knew a month ago that completions were going to plummet in April. And by the way, the plummet word and the plunge word are both back in the UK national press. We'll come to that too. But prices have remained remarkably resilient, remarkably resilient despite this drop in volume. Something else that we really knew. The interest rate cut on the 8th of May, again, something that was predicted here on MarketCast, boosted confidence from an extraordinary low where consumer confidence had gone. We'll do those numbers this morning, obviously. But then we had that big inflation jump in April. And I'm going to spend a bit more time than normal on inflation and interest rates this morning because they have such a huge bearing on the way the market moves. And I'm going to prove how that works this morning too. So we've got a huge amount to pack into the next 28 minutes. Let's see if we can keep it interesting. Few people, you'll remember this on the last MarketCast, the new word that I invented, tarifying, the invention of tariffs at a whim, seemingly, to frighten all your neighbours witless. And of course, that word's doing the rounds now. I'm delighted to see. Okay, let's not jump 2 slides. Let's just go 1. Hang on a second, I'm taking you back here. What the media are currently saying, and this is, inflation jumps to 3.5%. This was in the Standard. That obviously caught lots of headlines. It was a very disappointing number. And I've got to say, caught me out too. Didn't think it was going to jump that far. Nice picture from Rachel from accounts though, with a little bit of rouge on the cheeks there going on. Property sales plummeted in April. There it is. It's the P word, plummeted. And that was in the Negotiator. So the business to business publication there. We look here, this is the Mortgage Finance Gazette. TSB and Skipton change rates after inflation spike. The inflation spike is a worry, and it meant that constant fall in mortgage rates has been arrested, hopefully only briefly. How about this one then? In the Business and Accountancy Daily, property transactions fall off a cliff in April. We all knew it was going to happen, didn't we? Certainly regular viewers of this MarketCast knew it was going to happen. So we're not worried because it's going to even itself out. And we predicted that as well, haven't we? Zoopla had May as they actually say it's the busiest home buying May since 2021. There we go, there's Zoopla talking it back up again. House prices rise almost £3,000 a month despite stamp duty rise, says Nationwide. Well, we'll go underneath all of those press stories in the next 20 minutes or so. But before we do, I just want to perhaps take a more sanguine view of the way the market affects everybody across the UK. It's very easy to stand up here and talk average numbers, but that's not very helpful if your average is at that end of the scale, which Aberdeen, by the way, as against that end of the scale, which is Belfast. The range, and by range, I mean the difference in inflation between cities in the UK is absolutely enormous. Lots of different sources for this. I've just picked the Zoopla one because it's the most recent one that came across my desk. And on this Zoopla cities range, even if we just stick to England, from Brighton to Blackburn, we're talking about a 7% difference. You imagine that if you apply that to margins when you're actually buying a site, it's a huge number. So we have to keep that in mind as we're talking about averages. I know the old saying, and I don't mind repeating it again, the classic saying, good old Terry Flower from Alfred McAlpine Homes back in the 1990s. If you take a man and you stick his head in the oven and you stick his feet in the freezer, is he, on average, comfortable? And we all know he's not. Let's go back to consumer confidence, because this, as I've proven to you before, absolutely drives the way the market moves. And of course, consumer confidence relies on so many other factors that we'll cover during MarketCast this morning, not least of which is inflation and interest rates, of course. So, quick look then at the three indices here. Always start with the red line, because the red line is the overall index number. So that's the good measure of just generally how confident people in the UK economy, how confident people are feeling about the UK economy. And you can see this yellow line through here is 0. Anything below 0 means that the majority of the 2,000 people that they ask this question to every single month believe things are going to get worse rather than better over the next 12 months. And you can see it's deep down here in the negative. So the majority of people in the UK believe that things are going to get worse, not better, over the next 12 months. For us, it's really useful to dig a little deeper. 3 specific details that I always pull out for the survey. The first one here, the green one, is the next 12 months a good time or a bad time to make a major purchase? And you can see that although that is still deep in negative, there was quite an uptick last month, and that followed hot on the heels of the interest rate cut on May the 8th. If we look at this blue line down here, that is, how do we think the UK economy, the jobs market and so on, is going to fare over the next 12 months? Heavens. Well, you'd actually need a JCB digger to dig a hole in to get down to the depth that that index has touched over the last 12 months. It's hit record lows. And bear in mind, this survey is 45, 50 years old now, and these are record lows, but even that took a little bit of an uptick from its depths. The one that really interests us, and I say us because I know that the vast majority of the viewers of this MarketCast are in the new homes development market, is how people think their own personal finances are going to go over the next 12 months. Are they going to get better or worse? And it is a remarkably resilient measure. And even now, with everything that's gone on, you can see that it's just stayed on that level line. Some people think worse, some people think better. Certainly people as far as typical home buyer profiles are concerned, are very much in the positive. And you can see with that interest rate cut, you can see there that it took a sharp uptick into positive territory in May. Very good news. And that, if you think about the delay, and if you think about probably somewhere around 4 to 5 months in between these numbers here and how they show up on reservation profiles, This fits beautifully with our theory that we're going to have a summer dip and we're going to have a strong autumn, and I am still absolutely convinced that that is going to be the case. If we look at this lovely chart, don't forget, this is Property Mark data. So these are data sent in by members of Property Mark, independent estate agents that are members of the Property Market Consortium. I can't think of a better word than that, association. And they show the number of deals that they have done where they achieve asking price or better. I think this is a brilliant, at a glance indicator of where the market's moving. And you can see we're bobbling along. It's over 20%. We're talking over 1 in 5 deals. People are talking, on that early slide where we were talking about what the press was saying and how lots of people are taking discounts off of asking price. Well, not that many. It's an extraordinary number there. Almost a quarter being done at asking price or better. So let's see what's coming up next. This is what really starts to matter to us. The next inflation numbers we're going to see are only a couple of weeks away, really, June 18. They are going to matter substantially because the very following day after we learn the inflation figures, we then learn what's going to happen on interest rates. Let's take a look at what happened here in a bit more detail, shall we? We were coming down beautifully. This is February 2022. The Russians invade Ukraine. Energy prices go through the roof. Inflation climbs. And then, of course, the interest rate rises were brought in. 13 interest rate rises in the space of 2 years, which got this inflation under control, and we came back down the other side. We're bobbling along the bottom, roughly around the 2% government target, everything going very nicely. And suddenly we've started to experience this uptick. But if you look in these numbers in more detail, there's a very important aspect of this. Have a look at this line here. This is so important for us because when you look at these numbers on the news and you just talk about average numbers, what we're not doing is we're not separating the people that are in our target market for selling new homes from the rest of the UK population. This line here is owner-occupier housing costs. So while inflation has done a little clip up there, this really important number that I have drawn your attention to on every MarketCast I've done, because that really affects the people that are in our purview, well, you can see that has dropped significantly and continues to drop. That really matters. It means that these people, bearing in mind that wage inflation, where that sits, are actually better off. You can see there, let me just quickly hop back there one moment. CPIH, so that is the consumer price index with the homeowner content in, 3.4 up to 4.1. CPI 2.6 up to, this is the headline number, 3.5. But look at this, owner-occupier housing cost, 7.2. down to 6.9. Very, very important number. I actually put in here the factors that led to that increase in numbers. Housing and household services, that's where all that increase is. But if you look in here, of which owner-occupier housing costs, that was actually negative. So for owner-occupiers, those housing costs went down, not up. Such important data that sits underneath the headline data. And I'm not going to dwell on this. I just put this up here for your interest. So this is wage inflation versus regular inflation. So wage inflation currently running total pay inflation at around 5.5%. So if you take the 5.5% and then you take off general inflation, the real inflation, so how much better off we all actually are. And again, it's an average number, but it's almost 2%. It's a huge number. So that brings us to interest rates, doesn't it? So the next meeting of the MPC is the day after the next inflation numbers on June 19. Where's it going to go? Well, if we hadn't had that inflation spike last time round, I would have been absolutely certain where it's going to go. Now I'm not too sure, and I don't think anybody else is either. This is the story we've seen so far. This was the last reduction here, from 4.5 down to 4.25%. It's what we all knew was going to happen, didn't we? Absolutely flagged it. So the next one here then in June 19, will it come down another 25 basis points? Well, I'm going to guess that it will. I think that we will see rates come down to 4% despite that spike in inflation, because I think that the bean counters know that that was a temporary spike and things will be better. This shows you generally how interest rates have been moving. That last spike stopped this movement a bit, and if you look at the long-term money, this orange line here is 10-year money, that actually crept up a little bit last month. But look, here's the important number really, here's the headline number for you. Average rate for 90% loan-to-value mortgage has dropped under 5% for the first time in the 2.5 years. So it's 4.97% now, and that's the average blended rate for a 90% mortgage fixed for 2 years. That's a very important number for all of us. And I just wanted to, let me hop back. It's very sensitive this morning, very sensitive. I put this up not to dwell on it. I put this up because I want to show you why interest rates matter so much. Here we go. This is January 2022. This is a Zoopla chart, very clever. So this actually shows the growth in sales agreed. If it's below the line, it's negative. Above the line, it's positive. This red line here is mortgage approvals. Essentially, just take it that that's the way the market's moving. Here's where interest rates started to climb when Russia invaded Ukraine. Interest rates climbing, climbing, climbing. Look what the market's doing here. And then we get here to 2024. So this is where base rates started to fall. And you can see then the effect that that has on the market. We obviously had the stamp duty hiatus going on here. But I thought that was a really good way of indicating dramatically the effect that interest rates has on the way that the market moves. And you can be sure that that will continue to be the case. Right, so with all of that in our head, then let's have a little look at where it's going to go. That is May 2024, where we were a year ago, and we had really difficult mortgage rates, a low affordability, consumer confidence was sat in the middle, and then the rest of everything sort of along a broad line that wasn't really affecting things. Things were just slow. And if we come forward 12 months to where we are now, well, you can see stamp duty is a really big deal because we are just over the other side of the last change. So all of those rates have increased. Mortgage rates have moved up here. And let's not forget, we're looking for a new normal now. We're never going back to 1% or 1.25%. That won't happen. So our new normal, anything under 4%, and I think there's a very good chance we might see that before the year's out, anything in the late threes is normal. So those mortgage rates are moving up here. Consumer confidence is still very, very low, but improving, certainly over the last month. Inflation is less of a concern. Certainly homeowner running costs are sitting here, low impact. The employment market is starting to be a concern. And I'm flagging that on a regular basis, and that does affect consumer confidence and will affect the way the market moves. And for me, that's a drag for me. Certainly through summer, that will be a drag. Up here, of course, in this gilded top right-hand quadrant, positive effect, high impact, we've got part exchange, discounting and financial products, something that sits in the gift of the developers themselves, and that's a real opportunity to manipulate the market and grow share off the second-hand market for sure. Quick look then at the key indices before we look at where we think prices are going next. I flagged that up to you. Right move, 0.6% increase in asking prices in May, despite, what was it, falling off a cliff, volumes in April. I ring this round here. So after the busier than usual March, new buyer demand slowed in April to 4% below the same month last year. However, demand in the year to date is still 3% ahead of where it was last year. Extraordinary, but true. So difficult, yes, but certainly not impossible. Demand is actually there. You look at the nationwide, and of course, these are now brand new numbers. Bearing in mind that we're doing this at the beginning of the month, these are their May numbers, the very latest numbers. And you can see here, this upticked against all the odds. Certainly caught me out. I was expecting that to be a small fall. And it brings us to an annual change of 3.5%. Well, try telling somebody in Brighton that and then see how you get on. But maybe the people in Blackburn quite like that. I also stuck this chart. This wasn't there in the nationwide. I stuck this on the same slide just to show you these peaks stamp duty. That's what you get when you change stamp duty. There, all of those are stamp duty changes. So in terms of incentives on getting deals away, stamp duty is unbelievably effective. Second most hated tax in the UK. There we go. For me, the nationwide number that is most important, that really gives the light to those last numbers and really shows where the trend is the 3 month on 3 month numbers that takes out all of those little variances. And you can see where we've been since January. And that is the 3 month on 3 month. And that for me says all I need to know and convinces me that we have our summer dip. But it also, I'm equally convinced that we've got a good autumn to follow behind it. If we look at the Zoopla classic numbers here, 13% more stock now than there was at this time last year, and 6% more, a higher flow of new supply. But buyer demand, up 3%, there's that number again. And sales agreed, 6% ahead of where it was at this time last year. Big numbers. Volumes, you have to expect this, of course. So we come off the back here of the stamp duty changes, and volumes fell all the way down in terms of mortgage approvals to 60,000. And of course, we know all we need to do, divide by 2, multiply by 3. The number of mortgage approvals there gives us the number of completions 3 to 4 months further on. But this all feeds into the summer dip that we talked about, and it still looks absolutely nailed on. So we're going to have a difficult summer, no question about that. I believe that's all it will be, and I believe it will be coming back afterwards. These are the latest RICS numbers, and I think these endorse precisely what I'm saying. Generally, they say in their April survey, so these are members of the Royal Institute Chartered Surveyors who all send in their numbers. I think this time 401 branches from 200 responses to this survey. So it's a fairly small sample, but it's a very influential sample. And the charts in this survey are shown in the same way as the consumer confidence. So if a majority is positive, it goes above the line. If a majority is negative, it goes below the line. And this is a really good indicator, bearing in mind that the majority of the people filling these surveys out are surveyors. They are people that are setting the values on the properties that we are selling and that you are selling. And you can see their measures of new buyer demand and agreed sales weaken further. No surprise there. This did take me a little bit by surprise. It's more negative than I was expecting. I call these 2 slides the canary slides, because there's such a good way of flagging up what's coming next. I showed this to a fairly young audience not long ago, and nobody understood what I meant by a canary slide. They weren't familiar with the canary down the coal mine syndrome. By the way, if you're watching this and you're not, go Google that one to save me spending any time on it this morning. But this is new buyer inquiries over the past month. So this is the April survey. They're talking about March data. Look at this. All regions pretty much in the UK, very few exceptions, say that new buyer inquiries fell significantly during March. And that canary principle means that gives us that summer slowdown that we're talking about here. New vendor instructions staying pretty much about on it, which matches up to the Zoopla numbers that I've just shown you. But that's the really important one, and that points us to how the summer's going to be, obviously. Quick look at these 2 charts here. Over here, these are volumes, the numbers of properties being sold, the 3 month and 12 month expectations. Over here, prices, what price, average price they're going to be sold at. The blue dotted azure line is how things are going to be over the next 12 months. The solid mauve line, how things are going to be over the next 3 months. And you can see the majority of surveyors believe that there will be fewer sales over the next 3 months than there were over the last. But they also, majority believe there will be more sales over the next 12 months than there were over the last. It fits exactly with what we've been saying on MarketCast in terms of how the market, the shape of the way the market is going to move for the rest of this year, and prices exactly the same. Look, here we go. Over the next 3 months, the majority believe that prices will actually move into negative growth, and yet over the next 12 months, it's a massive majority that believe that we will end up the end of the year in positive average growth on prices. So important. So let's take a look then at where we're going to go in the second half. And I think the first thing to say is that I genuinely have been surprised by the resilience in prices. I'm not even sure I completely believe them, but I have always nailed my colours to the nationwide mast. There are lots of different price indices out there, possibly the most accurate being the ONS, Office of National Statistics numbers, but they are so out of date. I mean, the best you can get on ONS right now is March numbers, useless for us. So the best, it's no good looking at the right move numbers, they're asking prices, and we all know that they are not actual selling prices. So I believe that the nationwide is better than the Halifax in in terms of the two major indices. It's best of the bunch, and you can see there that it has held up remarkably well, and it's actually touched onto 3.5%. I had this forecast dropping down here, which is where I thought that was going to be in May. I still believe we are going to come off that curve. I'm absolutely convinced. I've slightly revised my negativity here and had them staying just in positive, but I'm still very, very confident about the number for the end of the year. I still believe that we are going to end up the end of the year at around plus 1.5%. And that means we saw this average price blip up here to 273,000 at the end of last week. The numbers that Nationwide released just yesterday, we have to come off of the top of that. I don't believe that we won't, and I see average prices moving like this, which means that our annual average inflation then is going to move roughly like that. That's how I see it. And in terms of volumes, well, that we're going to follow that same national pattern where we're going to see that dip in volume over the summer, and we're going to see the volumes come back in the autumn. The big question that you need to be asking yourselves is, do we put the tin hats on and get down in the trenches while summer is happening, or do we get aggressive and steal a bit of market share, maybe at the expense of a bit of margin in summer? And I believe those two things are the choices. It will be very, very difficult, I think, to maintain volumes and maintain margins where we are for the summer months. So in terms of where that leaves us then, by way of summary, summer dip is still very much a thing. It's still going to happen, completely convinced of that. Probably not as deep as I originally thought. I actually thought, I never saw it going into negative, but I always thought it was going to come down to pretty much flat. I believe that the upward blip in general inflation, although it gave us great cause for concern and obviously makes the people that set our interest rates think twice, I'm thinking it is just a blip. I think we sit back, we wait for maybe even not this month, but certainly the next quarter. There is a feeling in government undoubtedly for downward pressure on interest rates. That's the way that everybody wants to see them go. And so I believe they will naturally follow that path, and I still think we've got a couple of interest rate cuts to come before the year's out. I'm still staying with my annual forecast for average prices. We've talked about range, so we know what that's all about, but average prices are being about 1.5% higher than they were at this time last year. And despite the distortions in the volumes that the stamp duty changes at the end of March had, so we did see volumes plummet in April after soaring high in March. We knew it was going to happen. I think that's done now, and now I think we even out and we'll drop back in to around 100,000 completions per month, ending at around 1.2 million. I believe that's going to be the case, and I think that the new home share is going to stay at about 10% as well. Okay, we have somehow managed to get through all of that delayed data and deliver it to you in 30 minutes. Extraordinary but true. It is worth, I know that some of those charts are a little more complicated than 10 or 15 seconds does justice to. This video will go up on YouTube. As soon as it's uploaded, you'll be notified, and then you can have a look in a little more detail at some of those numbers out there. Next MarketCast, a date for your diary, We quite like now this new start or this new timing at the beginning of the month. It means we've got the nationwide numbers. We can be a bit more accurate. It's going to be Thursday, July the 3rd, 2025. Now, I also want to thank the team here this morning as well. Thanks to Hannah, to Joan, and we're losing James. James is leaving us, but going to a very fine place, joining the RNLI. He'll be sticking his camera underwater on the odd occasion, doubtless, purposefully, I hope, as against accidentally, but a huge thank you to James for being a brilliant stalwart in our production team in 31 MarketCast. But we've got young Luke Huckle coming on to carry on carrying the can. Thank you so much for sharing the last half an hour with me. Hope you enjoyed it. Hope it gave you a bunch of information, and I'll see you on July the 3rd.